In the past 10 years, one portfolio has outperformed the S&P 500, not just in total returns, but in dividend income too. This isn't a complicated strategy or portfolio, just a balanced mix of growth and dividends. Two ETFs that have proven to be stronger than the index that nearly everyone uses as their benchmark. In this video, I'm going to walk you through exactly how John discovered this strategy. We'll look at why so many investors start with the S&P 500 and why that's not enough. What makes this two ETF mix so powerful and how each piece works together to beat the market. Then we'll break down real numbers, year-by-year returns, a full 10-year backtest, and at the end of the video, we'll put John's strategy right up against the S&P 500 and look at the long game, 10, 20, even 30 years into the future. You'll see exactly how this simple shift could turn into an extra $1 million. When most people think about investing, the S&P 500 is the first stop. It's the backbone of American investing, the one place almost everyone begins. With one ETF like Vanguard's VOO, you instantly own a piece of 500 of the largest companies in the US: Apple, Microsoft, Amazon, Nvidia. That's about as diversified as you can get in a single click. Even better, it's cheap. VOO charges an expense ratio of just 0.03%. That's $3 a year on every $10,000 invested, basically nothing, and history backs it up. More than 90% of professional money managers can't even beat it. So for most people, it feels like the smart choice, the safe choice, and honestly, it's not a bad one. But here's the thing, if you're after real income, money that shows up in your account every quarter, the S&P 500 often comes up short. Sure, your balance might grow nicely on paper, but those dividend checks, they're usually small. Just enough to cover a bill or two, not enough to move the needle on your lifestyle. And that gap, that lack of meaningful income, is exactly where the story of this 50-50 portfolio begins. For John, the issue with the S&P 500 wasn't that it was bad, it just felt incomplete. His balance was going up, sure, but the income was tiny. The dividends barely paid for his internet bill. And he kept asking himself, if this is all I'm getting, how am I ever supposed to cover a mortgage, car payments, or even save up for a vacation? That's when he stumbled onto something that just made sense. He realized he didn't have to pick between growth and income. He could actually get both by combining two funds that play completely different roles. On the one side was Vanguard's Information Technology ETF with the ticker symbol VGT. John saw this fund as pure offense. It's loaded with tech giants, the very companies driving innovation and stock market gains. When the market is strong, VGT is like rocket fuel for a portfolio. But John also knew that tech can be volatile. One bad year, and those gains can disappear quickly. That's where the other half comes in, Schwab's U.S. Dividend Equity ETF with the ticker symbol SCHD. This one plays defense. Instead of chasing big moves, it focuses on reliable, established companies that have been paying dividends for over a decade. The income is higher, more consistent, and it keeps growing over time. The trade-off is slower growth compared to the tech rocket ship, but John didn't mind. And here's the best part. John realized these two funds barely overlap. One thrives in bull markets, the other steadies the ship in rough waters. On their own, they each have weak spots, but together, they cover for each other. To understand why this strategy works so well, let's look at each piece on its own. And let's start with the growth engine of the portfolio. So growth is always the most exciting part of investing. There's something thrilling about owning companies that are shaping the future, the innovators building technology the world relies on every day. But when looking at a plain S&P 500 portfolio, it feels watered down. Sure, Apple and Microsoft are in there, but they're buried alongside hundreds of companies that barely move the needle. What's needed is something more focused, a way to truly capture the power of technology without picking individual stocks. That's where Vanguard's Information Technology ETF, ticker VGT, steps in. This fund is almost pure tech, about 99% of it, and it's stacked with the giants. Apple makes up around 12%, Microsoft about 15%, and Nvidia over 18%. Just those three alone make up nearly half the fund. On top of that, you're getting exposure to over 300 more companies, from software leaders to chip makers, covering pretty much every corner of the digital economy. And the results? Honestly, they're hard to ignore. Over the past year, VGT is up more than 21%. Stretch it out 5 years, and it's gained about 120%. Look back 10 years, and the total return is nearly 573%. That's the kind of growth that can change a portfolio. Of course, rapid growth comes with risk. VGT's standard deviation is 18.68%, with market swings as high as 28.24%. In years like 2022, when tech gets hammered, it falls harder than the broader market. But this portion of the portfolio isn't about playing it safe, it's about having an engine that can push a portfolio far beyond average when conditions are right. So while VGT can drive massive returns, it needs something to balance out the ride. And that's exactly where the second half of this strategy comes in. For John, chasing growth is exciting, but it comes with risk. He's seen tech stocks soar, but he's also seen them crash hard. He doesn't want his entire portfolio tied to that kind of volatility. What he needs is a balance, something steady that pays a reliable income along the way. That's why he turns to Schwab's U.S. Dividend Equity ETF with the ticker symbol SCHD. Unlike VGT, which is all offense, SCHD plays defense. It only includes companies with at least 10 years of consecutive dividend payments, immediately cutting out weaker businesses. From there, it screens for cash flow, return on equity, and dividend growth, a rules-based process that ensures quality over hype. The result is a basket of about 100 companies spread across different industries. You've got defensive names like PepsiCo, healthcare leaders like AbbVie, energy giants like Chevron, and reliable brands like Home Depot and Cisco. No single stock dominates, and no one sector takes over the fund. To John, that felt like safety. And the numbers back it up. Over the past year, SCHD's return was modest at around 2%. Over 5 years, it's up around 46%. Stretch it out to 10 years, and you're looking at 128% total growth. No, not as flashy as VGT, but here's where SCHD really shines. Income. Its yield sits around 3.67%, which is more than 3 times what VGT pays. And those payouts don't just sit still. They've been climbing year after year, often doubling or even tripling over time. On the risk side, SCHD is also steadier in rough markets. It carries a standard deviation of 13.14% compared to VGT's 18.88%. In 2022, when VGT dropped almost 30%, SCHD fell only 3%. That's the cushion John wants when markets turn. Together, VGT and SCHD complement each other perfectly. One drives growth, the other provides stability and income. And at the end of this video, we'll put John's 50-50 strategy right up against the S&P 500 and look at the long game, 10, 20, even 30 years into the future. You'll see exactly how this simple shift could turn into an extra $1 million. For now, the question is, how does this mix stack up against the gold standard, the S&P 500, over the past decade? Let's take a look at the numbers over 1, 3, 5, and 10 years. When investors compare their portfolios, the S&P 500 is always the benchmark. So how do VGT and SCHD measure up individually? Well, let's start with VGT. Over the past year, it returned about 22% compared to 16% for the S&P 500. Stretch that out to 3 years and VGT is up 87%, while the S&P posts 56%. Over 5 years, VGT climbs to nearly 120%, while the S&P sits at 88%. The pattern here is clear. When it comes to growth, VGT will always pull ahead. Now, SCHD tells a different story. Over the past year, it gained just under 2%, while the S&P rose 16%. Over 3 years, SCHD's up around 11% compared to the S&P's 56%. Over 5 years, it returned about 46%, while the S&P almost doubled. In raw price growth, SCHD lags, but it wins in the one category VOO can't match: income. SCHD's yield is 3.67% with dividend growth above 10.77% annually, far stronger than the S&P's 1.17% yield and 6.23% dividend growth. Here's the interesting part. If you only look at stock price growth, VGT beats the S&P, and the S&P beats SCHD. But if you flip it to dividends, the S&P pays more than VGT, and SCHD pays more than the S&P. So you've got this funny split. One's better for growth, one is better for income, and the S&P just sits in the middle. That makes you wonder, what happens if you put the two opposites together? Could you actually get the best of both worlds? The only way to know is to look at the long run. So let's line up a simple 50-50 mix of VGT and SCHD against the S&P 500 and stretch it out over a full decade to see how they really stack up. One of the most common objections to any strategy that beats the market is, sure, it looks good now, but can it really last? The only way to know for sure is to look back at the past and see how this strategy would have actually performed. That's where backtesting comes in. By checking a full decade, you can see how this 50-50 mix of VGT and SCHD holds up not just when the markets are booming, but also when they're crashing. From 2016 through 2025, the results are hard to ignore. A simple $10,000 investment in this 50-50 portfolio would have grown to about $46,000. The same money in the S&P 500 would have been around $36,500. That's nearly a $10,000 difference. And here's where things get really interesting. If you look back over the past 10 years, the 50-50 mix of VGT and SCHD would have outperformed the S&P 500 in 8 of those years. It pulled ahead in 2016 and 2017 when tech was booming. It jumped ahead again in 2018 by losing less than the S&P when markets dipped. In 2019 and 2020, it rode the rebound even harder thanks to VGT's growth engine. 2021 was another strong year with both growth and dividends firing together. Then, in 2022, when tech took a beating, SCHD softened the blow and kept the mix on top. And in 2023, tech's strength gave it the edge once more. The only years it didn't win were 2024 and 2025 so far. In 2024, VGT's broader mix of sectors carried it slightly higher, while in 2025, SCHD's slower growth has dragged the portfolio behind. So no, it doesn't beat the S&P 500 every single year, but 8 out of 10 is a strong track record, and more importantly, the mix tends to shine in the moments that really count, when markets are on fire or when it's under stress. And that's exactly what makes this strategy so powerful. Income shows the same, if not better, advantage. At the start, the income from the 50-50 mix in the S&P 500 was pretty close, but as the years went by, the gap just kept widening. The 50-50 portfolio pulled further and further ahead, and by the later years, it was paying roughly double the income of the S&P. The S&P is fine for growth, but its payouts can feel tiny. By adding SCHD's strong dividends to VGT's growth, the 50-50 mix gives you the best of both worlds, bigger checks today and income that keeps climbing in the future. And the trailing returns tell the same story. Over 3 years, the S&P actually came out slightly ahead, but stretch it to 5 years and the 50-50 mix edges past it. Push it all the way to 10 years and the difference becomes clear. About 17.4% a year for the 50-50 portfolio, compared to 14.5% for the S&P. Now, a 2 to 3% gap might not sound like a big deal at first, but when you compound that every single year over a decade, it turns into thousands of extra dollars in your account. So, over 10 years, through rallies and crashes, the 50-50 mix consistently stays ahead of the S&P in both growth and income. But here's the question most investors really care about: what happens if you keep going? It's one thing to see 10 years of back-tested results, but what if you just stick to the plan and let compounding do its thing for 20 or 30 years? That's where this strategy really starts to shine. Look at the numbers. On its own, VGT doesn't pay much in dividends, about 0.45%, but its share price grows fast, averaging 21.78% a year. SCHD flips the script, higher dividends at 3.67% with dividend growth of 10.77% and steadier price appreciation of 9.04% annually. Blend them together in a 50-50 split and you get the best of both worlds. An average dividend yield of 2.06%, dividend growth of 10.55% a year, and annual price appreciation of 15.41%. To really see how this plays out, let's lay out the assumptions. We're starting with an initial investment of $10,000. Half goes to VGT, that's $5,000, and the other half into SCHD, another $5,000. On top of that, instead of thinking about annual contributions, let's make it simple, just $5 a day. That works out to about $1,825 a year added to the portfolio. And here's the important part. We'll assume this money is invested inside a Roth IRA. That means the dividends and growth compound tax-free and you don't owe anything to the IRS down the road. Every dollar the portfolio earns stays in the portfolio. So with those ground rules in place, $10,000 to start, split evenly, $5 a day added, dividends reinvested, and tax-free compounding inside a Roth IRA, here's how the numbers unfold over 1 year, 10 years, 20 years, and 30 years. After the first year, that $10,000 plus your daily contributions would grow to $13,572. Stick with it for 10 years, and the balance will climb to $89,131. By year 20, the number really starts to snowball, $447,228. And by year 30, the portfolio will be valued at $2,015,741, paying $8,428 a year in dividends. Now let's put the same setup into the S&P 500 through VOO. $10,000 to start, $5 a day added, dividends reinvested, all inside a Roth IRA. After 1 year, the portfolio would be $13,263. After 10 years, $72,560. By year 20, $294,941, and after 30 years, $1,072,663, paying roughly $1,356 in annual dividends. So that's still a solid outcome. Over $1 million is nothing to sneeze at, but when you stack it against the 50-50 mix, which ended at around $2 million, the gap is impossible to ignore. That's $1 million more, all from choosing a different split. Same starting point, same daily contributions, same hands-off approach, but a completely different destination. Want to know how to turn $20 a week into $7,000 in monthly dividend income? Click the video on the screen.